right, welcome back to the Know Your Numbers REI podcast. Your host, Chris McCormack, founder of Better Books, CPA, Certified Tax Planner, MBA. Excited to be joining you today as we continue a conversation around the one big, beautiful, formerly bill, now law, that has passed here in the United States and been signed into law by President Donald Trump. All of this taking place before the July 4th deadline that he set, and then he got to sign it on the 4th of July, which in his words, there was no better way to celebrate the birthday of America. It's exciting stuff. I think I want to have an independent mind and approach to it, which is hard because I am very much biased towards tax savings and wanting to strategically plan for our clients. I do understand why some people might hold out. I mean, some might hold out because they just want to hold out on everything that this administration puts forth. And so that's one reason. The other reason would be more of a reasonable approach in that you don't think tax cuts are beneficial when we are in debt at the level that we are in debt. And I am empathetic of that. And I can understand why that would be one's mindset. I am no expert in getting a country out of $37 trillion worth of debt. I know many people are concerned about that and how that will change things going forward. So with that in mind, though, I am excited that this has passed. And I'm also very excited about the specific topic that we'll be covering today, which is just a continuation of some of the other topics that we've discussed. We have now produced, I think, 6 or 7 episodes on this law. The first 4 were when it was still a bill and just discussing some of the key messages and tenets of that bill. And now that it's a law, we're going a bit further and there's new things that were put in and some things that were taken out. So we're trying to unpack as much of it as we can. It is a massive document, almost 900 pages long, and there's also some details that aren't tax related. And so we're not going into the detail about that. We're not going into detail about the Medicaid stuff and the Medicare stuff and other government programs. We're focused on taxes, and we want to focus on those that are important to our listeners. And today's is important to our listeners, especially those who have invested in a small business and are thinking about the sale of that business. Maybe you own the business and you are concerned with the taxes that come as a result of selling a business. This one today is about avoiding taxes on the sale of a business. Previously, up to the passage of this law, there is a section in the Internal Revenue Code known as 1202, which has to do with small business sales. And this is a code that we enjoy looking at, planning around, especially as it relates to those clients who are in the process of selling a business or have desires to sell a business, because there are specific requirements that you have to meet in order to qualify for this exemption. So today's topic is what's known as the Qualified Small Business Shares Capital Gains Exclusion, if you will. This is going to touch upon small business sales and how you can exclude the capital gains that you receive on the sale of a small business through legal efforts, and now how it got much sweeter with this new law. So a little background: Qualified Small Business Sales Section 1202 has been in effect. It's been in effect since we've been in practice and planning around taxes, and even since I've been a CPA. So I'm going to assume that it was put into effect through Donald Trump's Tax Cuts and Jobs Act in 2017. And it basically stated that as an investor in a small business or an owner of a small business, if your business is qualified under certain requirements, you can exclude up to $10 million of the gain that you receive through the sale of your business. And this has helped many people save millions of dollars in tax. If I used all of that and I sold a business and I excluded $10 million worth of gains through the sale of my business, then I would be avoiding about 23% all told. So it would be capital gains and then net investment income tax that I would be avoiding 23%. So that's $2.3 million that I would be able to keep that previously I would be paying. My $10 million would be $7.7 million if I did not plan accordingly and did not make use of this. If I did plan accordingly and did make use of this, I would be able to keep the full $10 million, saving myself about $2.3 $1.3 million. That is no small amount of money. That is a great benefit. We love providing that to those who meet it, but it just got even better. We now have the same law, except it's expanded and increased the exemption from 10 million to 15 million. So what was $2.3 million, 23% on 10 million, increases to about, what is that, 3.5, somewhere between 3.4 and 3.5. So you save yourself an additional $1.2 million in taxes just through that. But it gets better because now there's also tiered exclusions. So one of the requirements is that you have to hold your share in this business for 5 years in order to qualify. So if I invest in a small business, or even if I started a small business and it increased in value and now I get a gain worth $10 million, if I didn't hold it for 5 years, meaning I got that gain in 3 years or 4 years, I would be on the hook for all of those taxes. All of those taxes. If I held it for 5 years, then I qualify for this exclusion, as so long as my CPA is doing what I hope he is doing, then I get to exclude it. But anything less than 5 years, you did not get to exempt yourself from any taxes, and you're on hook for the whole thing. Now there are tiered exclusions. So if you hold the stock for 1 to 3 years, you can exclude 50% of the capital gains. You get 50% of the exclusion. So say in our example, I had a gain of $10 million. I held it for 3 years. I can exclude $5 million of the gain. I still pay taxes on the other $5 million because I have not held for the full 5 years, but $5 million, paying taxes on $5 million is better than paying taxes on $10 million. If I hold it for 3 to 5 years, so in between that 3 to 5 year mark, I don't reach the full 5 years, but I'm more than 3 years, I can exclude 75%. So in that example, I can exclude 7.5 million and pay taxes on 2.5 million. Again, better than what we were saying about paying taxes on the full 10 million. I now pay taxes on the 2.5 million. I save myself $1.5 million, give or take, in taxes by having this tiered approach and getting it done properly. And then anything over that 5+ years is 100% excludable. So if I sold a business between January 19th, 2025 through July 4th of 2025, that is eligible for this exclusion. However, there are certain requirements that I need to qualify for to make sure that I can exclude. So let's get into some of those. In order to qualify as a qualified small business stock, so that's what QSBS stands for, it has to be issued by a domestic CCorporation with gross assets not exceeding $75 million at issuance. So that can be troublesome because you get on YouTube or Instagram or TikTok or LinkedIn and everybody says, become an S corporation. But this is only eligible for domestic C corporations. So you have this dichotomy, or you find yourself in a pickle because there are some tax benefits to S corporations. But if I want to sell and I think I'm going to sell for a large amount of money, then being a C corporation is more beneficial because I can exclude the gains that I received. Corporation must engage in a qualified trade or business, excludes certain sectors like finance, real estate, investment trusts, professional services such as law or accounting. So investing in my business, unfortunately, will not qualify you for this exclusion. However, other businesses that are outside of law and finance and real estate investment trusts are ripe for the picking. And then stock must be acquired directly from the corporation or through specific exceptions like gifts or inheritances. So there are certain qualifications. The biggest hang up is that C corporation, because so many people want the S corporation. There's tax benefits to the S corporation, but a C corporation is beneficial if you expect to grow to a level that you're going to sell for a large gain in the future. Now you also have to hold it for 5 years in order to qualify for the 100% exclusion, and the $15 million exemption applies per taxpayer per qualified small business, meaning multiple qualified small business investments can yield multiple exemptions. Say I invest $1 million into business A and then another $1 million into business B. Say business A sells for a multiple and my share is $15 million. I can exclude all of that gain, the 14 million, 15 minus 1, the 14 million, all of it. Then I get to business B and same thing happens. I invest $1 million. Let's say this one it sells for $10 million, my multiple. I've held both for 5 years. I am eligible for this. However, my gains between the two of them are more than $15 million. If you're working with a traditional tax preparer who doesn't know the ins and outs of this law, you could be in trouble because 14 plus 9, the gain on the 10 million, is $23 million. That's more than $15 million. Somebody sees that and they say, you don't qualify. I'm sorry, but you have to pay taxes on all of it. That's not true, because in the law, it says that if you have multiple small business investments and they both qualify, you can exclude the gain on both of those because it applies per taxpayer, per qualified small business, right? There are opportunities to save on tax greater than the 15 million in the event that you invest in multiple small businesses and get a large amount of gain on those sales. Who is this for? Why is it important? Again, it's for those of you who are investing in small businesses, whether it's your business or somebody else's business that you're just putting money into. You can exclude up to $15 million held for the full 5 years of that. You can exclude $15 million of gain on the sale. So obviously these are people who are dealing with large payouts that come from investing in small businesses. It's not for everybody, but it is for those of you who do have these large investments into specific corporations, or you're thinking about those, or you're thinking about starting a business. You know that in more than 5 years, you're going to sell the business, because we work with clients like this who are in that startup phase. Again, we just talked about research and development just last week. That's a piece of this puzzle when it comes to startups and planning your startup correctly. But if you know that you are going to invest a lot of money, and it doesn't even have to be a lot of money. You might invest $100,000. I have a prospect right now who invested $70,000 into a qualified small business, or just a small business. It might not even be a qualified small business. I'll keep it generic. And in a few months, anywhere from months to a year or two, they're going to be receiving $40 million from that investment. So a $70,000 turned into a $40 million payout in a short amount of time, right? So it doesn't have to be a large amount of money that you parked, because some of these businesses take off and they're in an industry that people want to be involved in, and they have money coming in from capital markets and private equity, and all of a sudden they have a large opportunity on their hands, and what was $70,000 is now $40 million. And if you're not careful, that's going to be a large tax bill. So we're going to be considering this as a tax strategy, and it's important that it's done correctly, because you can qualify but not actually receive the benefit if it's not done correctly. But if you find yourself in that early stage of business and you have high hopes of selling at a large multiple of what you're putting in, then there's certain strategies that you need to plan around, because again, you have to hold these investments for 1 to 5 years. You need to be eligible for 5 years, okay? And another part of it is that you need to have a less than $75 million of assets at issuance, right? So it is kind of assumed that these are small businesses, and so maybe not large dollar amounts are being put into these businesses. And so my point is that there has to be planning done before the sale happens in order to qualify, right? If you hold the stock for 5 years and you're about to sell, but you've only been a C corporation for a year, then you don't qualify. You have to be a C corporation for those 5 years in order to qualify. And so this is a tax planning strategy, not only for people who are about to sell that might qualify whether they realize it or not, but also for people who have the goal of selling in more than 5 years, and they expect a large payout from that sale because they know that their offer is great, or they've talked to private equity firms and they said, go ahead and build this for 5 years and we'll come and buy it, assuming that there's certain requirements met in the form of like revenue or earnings per share or whatever. So you want to be planning. If you know you're going to be selling in 5 years and you say, oh, I need to be an S corporation because somebody on YouTube told me that there's a tax benefit to being an S corporation, then you're setting yourself up for failure, because in order to qualify for this exemption, $15 million of your gain being excluded from your income, you need to be a C corporation for 5 years, right? So the strategy is twofold. One is for those people that are about to sell, they own shares in a C corporation, and you are worried about the tax bill that comes from paying taxes on a gain of $15 million. Work with a strategist who knows about this, knows that the threshold increased, and knows how to implement it so you're not raising any red flags and you're not paying more than you need to in tax. if you have goals of selling a business in more than 5 years and you're kind of in that startup phase, or maybe you're expect to hit a large amount of growth, we want to be planning around an entity structure through the use of this tax law. It's great in the possible payout when it comes to the opportunity that's available, but there's also a lot of things that need to go right in order to do it. And one of them has to do with the entity that you choose from the start. So if you are not working with a tax strategist, or you're working with a tax preparer and you think he's a tax strategist, but you guys aren't talking about this even though you want to sell, you're in the wrong area. You need to find somebody who is qualified, who has the knowledge, who understands that the law is changing and getting even better for somebody like you. And even if you're not somebody who might qualify for this qualified small business stock exemption, there's a great amount of opportunity. You can go back to the previous episodes that I've done and listen to future episodes that we'll do about this tax law and find out that there are things available to you that you're probably not taking advantage of because, well, you're running a business and you're investing in real estate and you're busy and doing what it is that you do best. You don't have time to try to unpack this tax code. And that's why we do what we do in our research and in our implementation and in our relationship building with our clients to make sure that the burden that taxes have been and will continue to be is no longer the case, because they have somebody that is there directing their steps and telling them, you're eligible for this. Oh, you're selling your business? How long have you owned it? What's the entity structure? Oh, you're thinking about selling a business, you're just starting out. Let's do this entity structure because this is what's going to happen. So if that sounds like you, if you're just frustrated with the lack of expertise that you've received, the lack of communication, the lack of direction that you've received, or you're worried about a large payout that you have coming and the amount of taxes that you're going to be paying, we'd love to get in touch with you. We'd love to unpack your situation, see if we have something that fits your needs, and see how we can keep more money in your account and help you reinvest as you continue to grow your wealth and save on tax. Until next time, God bless you and keep moving forward.